we we will record it and then and share it with you all. So welcome. Thank you all for joining. My name is Kenny Herron. I work for CTA, and I am one of the fiduciary advisors that is hired on by the union as a resource for all CTA members. But you don't have to be a CTA member for us to help you. But nonetheless, what we have been brought on to do is to help members make good financial decisions. And, you know, um, what mainly comes into play is different aspects of your income that we want to start to think about preparing for as we make that transition into retirement. So, we'll discuss a handful of topics today. So, um, if I say something that doesn't make sense or is not clear to you, that's my fault. I always have to say that's not your fault. That's my fault. So please, by no means are there stupid questions. I always want you to leave here feeling like this was worth some value. And in best case, you take away saying, "Hey, this was such good information that I want to share it with someone else, or that I understand it well enough to be able to share it with someone else." That's the goal. So, without further ado, I'm going to go ahead and press forward in in the slide deck here. But this is a really cool thing. Before we really dive into um, what we're going to chat about today. This is actually just something we're still celebrating even a year later, but the web and the GPO are gone. And if you don't know much about this, you don't really need to know much about this. But nonetheless, there was prevention that affected your Social Security income based on your CalSTRS income. And thankfully, those laws have been repealed, and it's a huge savings to all of the members that are impacted by this. And so if you've ever worked a previous job or you have money in Social Security or planning to get a benefit from Social Security, there would have been an offset and there no longer is. And so it's a really wonderful thing. So you can take that into consideration as you're starting to plan and prepare for retirement. So um, one of the themes for today, and I'll give you a kind of a more intro and overview of what we'll get into here in just a minute, but one of the themes you're going to hear me talk a lot about is inflation. It's one of the biggest bugaboos, as I say, for things that we need to be concerned about, or at least be mindful of as we're making preparations for the long run. And so Robert Burton, he's a Nobel laureate and famous for, for a number of things, but he kind of distills some complicated topics, and it has a real gift for distilling them down to making them a little bit more simple and easy to digest. So, he says here, an inflation protected income for life to sustain the standards of living you enjoyed in the later part of your work life, right? And so we're keeping in mind that when we transition, or we're talking about a successful retirement, going forward here, what that means to me may mean something different than it means to you. But nonetheless, a successful retirement for everyone should be that you can transition into retirement or the phase of retirement without having to take some dramatic step back in your lifestyle, without having to sell assets or make some dramatic changes. You want to be able to work throughout your career and improve your lifestyle as you go, and then get to retirement and maintain that. So to us, that would be a success, is to be able to transition into retirement, keeping the lifestyle that you have and not have to make any dramatic changes. And so, oftentimes, we want to think about it as if, there's some red button we press and we just become wealthy overnight. And that's the quick option is never the right choice, right? So what we try to do is give you the pathways forward, or the playing field, so that you're most prepared. And obviously, the more time you have to prepare, the better things can be, for you down the road. So, um, one of the here's the playing field, I should say. So this is like the four kind of main areas of income that you can expect, as you transition. So, and this is kind of what we'll talk about each of these in a little bit more detail. I suppose we already kind of mentioned the Social Security aspect. So we'll get into talking about the pension and give you some kind of back of the napkin estimate and kind of walk you through how that might shape out or how that works. But some fundamental principles in the pension go a long way for what that will mean for you in the long run. Also, we're going to walk through 403bs, IRAs. You can think of 457s. So 403b is just a placeholder for, we try to keep the slides clean, but for outside savings beyond the pension. And we'll talk a lot about why that's important. And then obviously you have personal savings, right? So anything you do in the real estate market or any type of outside investing you do in a brokerage account, or we always make the joke if you collect baseball cards, or maybe later in life your plan is to upgrade your spouse or something like that, right? You can always shift things around, right? But nonetheless, all of these assets that you accumulate in assets being obviously cash that you have, but also income sources, because your pension will be an asset of yours. We want to make sure we get that right. And if we can get, the kind of the foundation in place, anything that we do beyond that inside of like a 403b or your personal savings is really hopefully going to be in addition. But for many folks, it's not the case. For the pension, it's an excellent benefit. But it's just the way that it's designed. It requires you to be in the system and working for a really long time in order for that smooth transition of replacing your full income. So what here is the CalSTRS formula for how they compute your benefit. And so we'll walk through each of these, but it's actually a pretty straightforward formula. And what I think is kind of nice about it being a formula is that you can really play around with the inputs to really run different scenarios for yourself and figure out what's the ideal time, or at least what percentage of my income can I get to at the date at which I'm most comfortable retiring by, right? And so what this allows you to do is run that, what happens if I retire at 55 versus what happens if I retire at 60 or 65? And as you'll see, it will make a dramatic difference in your benefit that you get from CalSTRS based on just a few years in the pension system. So we like to spend a little bit of time on this because if you get this part right, here's one of my cheesy jokes is if you can get an A in pension, that should be the bulk of your income, and you're already so much of the way there. But you got to understand how it works, and if you miss a couple small details in how it works, you could potentially lose out on tens of thousands of dollars over the course of your retirement. Even if it's $5,000 a year difference, if you're, God willing, alive for 10, 20, 30 years into retirement, you start to do the math there, and it's a big number. So try to focus on getting this right. So the first thing is service credits, right? So think of service credits as 1 year worked, one service credit. So if you work part-time, you can get a partial service credit. It works on a decimal basis. So if you're at an 80% contract and you work full-time for a year, you'd get 0.8 service credits and things like that. So CalSTRS, I should mention, if you haven't gotten access to your CalSTRS account, you can go to their website and create a login for yourself and go in there into your account with them, and is where you'll see where they track all of this for you. So if you're in a CalPERS, by the way, I should have said this from the beginning, most CTA members are CalSTRS, but for those folks who may be in PERS, just know it works very similarly. Everything that we're going to talk about today, um, the numbers are a little bit different, but the mechanics of how it all works is very similar. So either way, though, whether you're in CalSTRS or CalPERS, I would say go to the pension systems themselves and get your login so that you can track these things. And I know in CalSTRS, they have a calculator in there that you can run some scenarios for yourself that makes it even easier than actually doing the hard math like we're showing you here. But anyway, so let's say, the average educator typically works somewhere around 20 to 25 years of service, right? So I'll run an example formula for you and just kind of show you how it typically plays out for the average CalSTRS recipient. But you take service credits, you're going to times it by something known as an age factor, and I'll get into more detail on the next slide about this. But just know, basically, your age, how old you are when you go to retire, makes a significant difference and impacts how the overall formula computes. But basically, each age has a decimal associated with it. So at age 55 is the earliest that you can retire. That decimal is 1.4. As you get each year that goes by, it goes up by 0.2. And I'll show you more of this on another chart. But you can understand how, as you get older, that decimal gets bigger and bigger. And then eventually, the last input to the formula is the final salary, is your final salary, and you'll have to compute that. Oh, I'm sorry. You'll have to figure out your final salary based on, for everybody, generally, you have to do 3 years of consecutive earnings at any point in your career. You have to average those 3 years to get your final salary total computation. So an easy example for that would be if you made 95,000 one year, you made 100,000 the next year, and 105,000 the following year. You add them all up, divide them by 3, and your average final salary is going to be $100,000 in that example. So we don't know, of course, once you finish this formula and you do it and you run it on yourself, you don't know the specific dollar amount per se, especially if retirement's 20 years from now. But you will get an idea of what percentage of your income will be replaced based on how the formula is starting to shape out. So I got a question here. So after 32 years of service, my birthday is in August, so age factor. The age factor will be an age at the end of the school year. Which year? Okay, so yes. So the age. So the question is, how does the age factor impact? How does it change? Is it by the school year or is it by birth year? And I'll show you in a minute here. It is impacted obviously by your. I'll show you. Maybe let me just put a pin in that question actually really quick before I get too far ahead of myself, because that's on the next slide. So I guess fair enough. I'll just push forward and I'll show you this. This worksheet is typically what we'll hand out at like a conference or when we're doing workshops in person. Again, I'll share. I'm going to share the recording, but also the slide deck. So you can hopefully get this and print out maybe a PDF version of this if you wanted to run your example for yourself. But let me just kind of walk you through what you're looking at first, and then if you decide to do an example or an estimate for yourself, you kind of know how to do it. So first things first, you're looking at 2 different charts on the bottom. And chart on the left is obviously if your hire date is prior to 2013, you're in a different chart. You're known as the 2% at 60 group. And then if you're hired later than 2013, you're in the 2% at 62 group. And the reason that matters is it changes the table slightly. So you'll obviously want to know what your hire date or when you were first hired, and it's first hire date. So if first time you ever stepped foot in the classroom, and were covered by CalSTRS. So if you signed up some time ago, let's say you became an educator, you started working under CalSTRS in 2012, and then in 2013 you took a break for 10 years and you just came back recently, you're still going to put that 2013 date you're going to go off of that, because that's how CalSTRS, or sorry, I should have said your 2012 date, because that's what CalSTRS is going to go off of. So so for the average pension recipient from CalSTRS, or I should say CTA, they typically work somewhere between 25 and 30 years. I should say 20 to 25 is pretty common. 25 to 30 is less common, but still many members do it that way. So this will show you at kind of the best case scenario, if you're planning to work 30 years. Obviously, if you were first hired in 2025, your hire date is going to be, or your years of service is going to be completely different. On this chart, it's just showing you, though, that if you were to maximize your age factor, and this is probably the most important, whether you're at the 2% at 60 chart, or you're on the 2% at 62, either chart, the age factor, starting at age 55, is going to incrementally go up and will maximize on the 2% at 62 chart. It maxes out at 65. Excuse me, 65. And on the other chart, it maxes out at 63. So there's some more detail that's worth knowing. If you're on I'm going to go back one slide here. If you're on the 2% at 60 chart, you can see here how the 2.4 is the maximum that you'll get at 63. And if you have 30 years of service, by your 61 and a half birthday, you will actually get a bonus by CalSTRS. So that actually is what allows, if you've ever heard your colleagues retire at 61 and a half, the reason that is because they have 30 years of service, and CalSTRS gives them a 0.2 bonus, which moves up their 2.4%. Actually, if you look on this chart at 61 and a half, so on your 6-month birthday, the chart is 2.2%. So if you get the 0.2 bonus, that maxes you out at 2.4, basically 18 months early. So it's a really nice thing to know. If you're kind of hovering right around, say 29 years of service, we would say dig deep and figure out how to work a little bit longer, or if you can, or make sure that you kind of are aware of the consequences of not staying a little bit longer, and how that will make a big difference in your income benefit. Because you could imagine, if you have 20, or we'll say 30 years of service, times 2.2 versus times 2.4, the output of that formula is going to look a lot different because of that. So highly encourage you to run through the pension, get your own numbers. You can see, obviously, in this example, you can potentially replace 70 more, potentially more than 70%. It's possible to replace 100% of your income. But you got to work a really long time, and you got to have, you obviously have to wait to max out your age factor in order to do that. So, if all of that seemed a little complicated, this might be a really simple and easy chart for you to see. So, pretty much if you're in the 20 to 25 year mark, you can really expect about 50 to 60% of your income to be replaced through the pension. If you're somewhere around the, maybe 30 year mark, 60 to 70. And if you can get over 30 years and you wait until your early 60s to retire, you're more than likely going to get more than 70%. So let me make the world a little bit better if this feels depressing in some way. uh, that it doesn't get you all the way there for working, 3 decades. You currently, right now, nobody in here is living off of 100% of your income, your true income. Your net income um, is actually, in our estimation, about 80 to 85% of what you actually make, your 100% of your income. And the reason that I make this point is because if you think about it, 10% of everything you're earning right now, your true gross income, is going to the pension automatically. So that actually brings you down to about 90%. And then if you're making, if you have health insurance coming out of your paycheck, if you're contributing to a retirement account, if your local union dues, all of those things that are kind of being filtered from your paycheck, those go away in retirement. So you don't need to get to a full 100% replacement through the pension in order to see the same paychecks you're seeing now, or in the future. Really, if you can get to somewhere between 70 and 80% in the pension, you're actually on track to almost getting the same paycheck that you're seeing today. So hopefully that makes it a little bit easier to swallow. But nonetheless, the average person's looking to retire somewhere about 50 to 60% through the pension. So, glass half full. And if we're identifying, what that gap means, right? How do we fill that up? And so that's where we come into talking about the importance of having an additional savings beyond the pension, like a 403b, like an IRA or a 457. But we'll focus on 403bs. They tend to be the most popular. Um, and so there's some reasons for that. We'll get into a little bit. But what is the role of a 403b? If you've never heard of a 403b before, or you're kind of like, what is that funny name, with letters and numbers? I'll just say people in my industry are really uncreative. And so they just went straight to the IRS tax code. More people are familiar with the IRS tax code 401k. So if you've ever, if you have friends or family or folks that work for a private company, or you work in the commercial sector, that company will provide you a retirement account, and it falls under the tax code 401k. As an educator, or as somebody who is a employee from an employer of the state, it changes the tax code because of where the money's coming from. That's it. Other than that, the 403b functions the exact same way as a 401k. And actually is governed by pretty much all of the same rules. And it's really designed to close that income gap that's so commonly experienced if you were just relying on the pension. So the big deal is it really allows you, or keeps you from living potentially paycheck to paycheck. If all you have is the pension as a form of income in the future, it's going to be very similar to the way you get paid now, once a month, and there's no advancement on that. If you say, hey, Cal Stirs, I want to go to Hawaii in June, they're going to say, great. I hope you can save for it, but there's no way to say, can I get 6 months of advance because an emergency happened, or you want to take a vacation. You can't do that, and so having that outside bucket of savings gives you that option to dip into your wealth that you've saved without having to siphon from your month to month pension earnings. So another really common use case is for a 403b is most of your colleagues tell me that they want to retire early, right? You want to be able to retire sooner. So if you know the pension kind of is what it is, or you're comfortable with the date at which you've kind of picked on the calendar or earmarked for when you're going to retire, regardless of what the pension estimate tells you, more power to you, by the way. But I would say that in that case, 55 is your date that you're exiting no matter what. You're going to get a really low benefit from the pension, even with 30 years of service. You have to understand that. So having a 403b will be critical to potentially being able to retire sooner, um, so that you can afford retirement sooner, if that helps out. So okay, and then the last thing is you want to think about healthcare, right? If you are determined you're that 55-year-old retiree, something to think about is Medicare doesn't kick in until 65. And most districts will offer a bridge or a gap insurance that typically lasts 5 years. Some some folks have it negotiated differently. So you always want to look into what your employer offers as healthcare and gap insurance. But even still, if you're going out at 50 in your 50s, healthcare, if you're not covered, can be extremely expensive, talking thousands of dollars a month. So if you have a 403b or outside savings, that's another way that you can help fund your insurance until you are covered, either through your district or through through the government. Okay, so here's some updates. Oh, this is I should have updated this slide for the current year. So, but actually, I'm going to just press ahead a little bit just to kind of keep things on pace a little bit. But ultimately, that was a contribution slide, just really talking about how much you can put in and the differences between an IRA or an IRA and a 403b. So, everything that we're going to kind of chat about now going forward, really won't matter to you unless you take the next step, right? And so I always think after doing this for the amount of time that I've done it, it really does seem like for most people, the hardest step is just to set something up or to get something in place, because tomorrow turns into next week, turns into 10 years. And so I always make this point before going ahead and kind of getting into the weeds and the details of 403Bs. It's important to just think about the impact and taking action, right? Because everything that I'm going to talk about really won't mean anything to you or impact you in any way unless you do something with that and take action. So, I think it's worth just knowing. So, 403Bs, the reason they work and how they work is they're set up directly out of your payroll. So, in a way, it forces you to save. It doesn't force you because you can always change the dollar amount. You're going to pick the dollar amount that you get to save. So if you want to, pick a round number, say $100 or $200 a month or $50 a month, there's really no minimum. The maximum is pretty high. For everyone this year, it's $24,500 for the year. So really high. But the reason it works is because it makes you save the money and invest the money before you spend it, right? It's kind of the most practical way to think about it. It's built into your budget. So you pick the dollar amount, but going forward and as you live, you just get adapted to your income. As that flow of money comes into your pay, each or into your bank account, each pay cycle, you adapt to the dollar amount that you set for yourself. So you contribute regularly. So you can't talk yourself out of doing it, or you don't have to forget about making some contribution payment or something like that. It's not how it works. It comes straight from your paycheck. So it's managed. Any type of investing that happens typically is managed for you. So you don't have to be a real guru or anything like that to take advantage of getting a rate of return and growing your wealth. And then there's obviously tax advantages, both pre-tax and after tax, like a Roth situation. You can set your 403b up either way to be pre-tax or Roth. And there's really some amazing advantages to doing the 403b just for tax reasons alone. So here's kind of the formula for how to maximize or get the best success out of your 403b. And by the way, largely what we do for the union and for the union members as fiduciaries, and if you've never worked for the fiduciary before, we're legally obligated to tell you what's in your best interest. So we don't work off of commissions. So I should say what that practically means is we don't work off of commissions. We don't sell products where that's not how we get paid. We're salary based, and whether someone does or doesn't enroll doesn't impact or motivate us. Unlike a lot of other 403b programs out there that have sales agents and that are typically insurance agents. So the reason the reason that's important to have a fiduciary is because we have a criteria for what we think makes a good program, and just practically speaking, and we want to make sure that all CTA members are held to that fiduciary standard. And so we came up with, a few simple things that we want to see in our 403b programs, or any program that we would implement, or that members have outside of the 403b program. If they meet that criteria, we would say that's excellent. Keep doing what you're doing. But if not, hey, here are some options, or here are outside options, not just the CTA plan, but other programs that do meet that criteria and that meet our fiduciary standard. So, the first thing is you want to maximize your contributions, right? And there's no other way around it, regardless of what your rate of return is, regardless of what your fees and all of that stuff is. That all matters. But the biggest determining factor of what your account will be at the end of your career is, and it may seem obvious, but it is true, is how much you fund it, right? So you have to maximize what you're contributing into it in order to get the biggest benefit out of it. Too often I see in this case, most people, where they start is where they finish, and that's not the best case scenario. If you start with $100 when you're 25 and early in your career, you don't want to finish at $100, when you're in your 40s, 50s, and 60s. You want to think about increasing and maxing what you can save to give you the biggest account. So beyond contributions, the next thing we want to do is we want to minimize fees, because fees, in my mind, are like holes in the bottom of your boat, and you're just leaking your own savings out because of one reason or another, in the way that the costs are affecting you. So we want to minimize fees, maximize contributions. The next thing that matters significantly is the rate of return and how the account is being invested, managed, and growing. So we'll spend some time talking more about this, because this is a big topic in the world of 403bs and investing. And so a little bit of some basic finance principles, I think will go a long way in helping understand how at least we view the 403b in that respect. So, and then beyond that, it's time. Time wherever you are in your career, whether you're just starting out, you're mid-career, or you're later career, getting ready to retire. The best thing you can do for yourself is maximize the amount of time that you have left. So carve out some, as long as you're getting a paycheck coming in, you should be carving out some portion of that paycheck to be stowed away in a savings account for the future. And it's just simple, good practice to be doing that. Now the question is where and how to save that. And so 403bs, not just because it has a tax code, the name 403b, not every 403b program is designed and operates the same way. They don't. They are offered by lots and lots of different companies, and different companies obviously offer different financial products, and they all range in the costs and how the plans are set up. So much of what we do is we help members discern what are the differences amongst the plans, what do the costs look like, how are the plans investments organized, and do they make sense? Do they meet that fiduciary standard for what we think is makes sense based on all of the factors about being an educator, and your pension, as we talked about, heavily weighs into that. So knowing not all 403bs are the same is important, because it doesn't allow you to just put a blanket label on this. You have to understand that that there are differences, and that's what we will help, and I will kind of guide you through what those differences are now. So a kind of a simple place to start is 403bcompare.com. This is a website actually ran by CalSTRS. I have to preface by saying that this website has its limitations when you're weighing out 403b programs. And the limit is that it assumes all these programs have a total account balance of $10,000. Um, it, you'll see in a minute here of why that can be a problem. But for kind of a baseline and get some good information about who your district works with, who the payroll administrator is to get your payroll and all of that connected to your account. Some good information here for you. So, but I always just kind of caveat the fact that there are some limits to its ability to weigh out, and compare 403b programs for you. So now I actually, I'm going to go ahead and stop sharing real quick because I did, well, I'll show you this just a sec. Looked up the your district's 403b. So I'll show you if you click onto find employer here and then punch in. Let's see if I can pull this up. Oh, nope. Well, you know what? Why don't I do this? I'm gonna just I'll show you this maybe towards the end of the presentation, just so that we don't lose our place here. But it's a nice place to see the vendors that you have access to, and it looks similar to. Let me go ahead and share this. Can you all see the screen? I just want to make sure I'm sharing this right. I think okay. So if you went here, hit find employer, your page would look like this, except obviously this is Santa Rosa City. And if you look down here, you'd see your vendors, all the vendors you have access to. But what's important to know about this page is on the bottom right corner, you get the salary reduction agreement for your district. So if you ever make changes to your 403Bs, your contribution amount each pay cycle, this is where you can go to make changes and find that form. And so no matter what 403B company you set up your account with, you have to go through the third-party administrator. In this example, Santa Rosa City's third-party administrator is this company here. Yours, I actually looked up, is third-party is Omni, OMNI, and they are the ones who process payroll. So I can show you that once we stop recording here. I'll show you the page on their website for you. So, but in most cases, you got 30, sometimes 40 different vendors that you have options to. And by the way, CTA, it's who I'm affiliated with. That the only reason that's highlighted is because I'm a fiduciary. So we're very, very transparent about disclosures. So everyone is okay with, and everyone understands and knows that's who I'm here to on behalf of. So there's no other reason other than that to highlight that we are just a plan that's accepted in a lot of districts across the state, like many others. Now, one thing worth knowing is, and I'm going to go back a slide, and this is just a 2 cents of worth knowing for you, and kind of give you some protection against different sales tactics that you might be exposed to out there. So approved vendor, you'll see this here, and approved vendor is a term that, in my opinion, is really misleading for most educators across the state, because it implies that the district has done some type of vetting and is endorsing the vendors on this list in some way. Just to be clear, no district endorses any type of financial institution, because that would assume that they have the liability of that financial institution, and no district wants to take that liability, generally speaking. So in which case, if you ever hear someone show up on your campus and say, "I'm approved by the district," just know that actually doesn't give them anything other than a payroll slot in the district to allow folks to use their company. it does not mean that they've done any type of endorsement or research into that company on your behalf. So just be aware. Approved vendor only means that you can use them, and other than that. So the biggest problem I think a lot of CTA members have is they get to this point and they have no idea discerning one company from another and why one company is better than the other. And so what I'm hopeful to do today is to give you some tools and give you our criteria so that we can really dramatically limit this list. And typically once we run that through our filter and what our standards are, this long list of 30 plus vendors, in some cases 40 plus vendors, gets narrowed down to one, two, or three ultimately. So, but I want you to understand how we got determined that it's not because of we're friends with these companies in some way. It's just because of some basic principles that they are adhering to versus most of these other companies are really expensive. Their plans are designed in a way to siphon money from your retirement and help them retire and not you. So, so much of what we do for CTA is in the fight to protect our educators across the state from insurance companies that, in our opinion, are really taking advantage of our members. So, okay, so kind of take a step back and go back to Finance 101 principles. So, two big risks to the future, right? We have volatility, so markets going up and down. But volatility, that's short term. Think about it, right? If day to day markets are up, markets are down. One thing I always say, right, is like, I know going into this upcoming year that there's like two things I can be sure of. The market's going to go up and then the market's going to go down, right? And it's going to go back up and then it's going to go back down. That's what it does, but it recovers. Generally speaking, we have 100 years of good finance data. So anytime the market's gone down, it's always returned and recovered to a newer high. Certain markets, obviously the big markets that we're all concerned about. And then we have the next risk to our future is inflation, but that's kind of more elusive. We don't, a handful of years ago, we would do this presentation and I'd say the word inflation and I could just hear people's eyes kind of gloss over because it's like this thing that we kind of know it affects us, but we don't really understand the impact and exactly how it impacts us when it gets explained to us. However, until recently, I think we're all pretty aware of the impact of inflation, right? Gas prices get crazy, housing costs gets crazy, health insurance costs get crazy, egg prices going up, getting crazy. We all, I think, can understand the impact of how just common goods around us and the way that we live our lives gets more expensive as time goes on. And the problem is that when you're comparing these two risks, most people are generally more concerned about volatility because it's unknown, versus inflation is kind of this expected thing. We just kind of know year over year, 2, 3, 4% of things around us get that much more expensive every year. But financial markets going up and down, that seems to scare us because it seems so, unsure. So I would tell you, from a fiduciary perspective, in the long-term plans for retirement accounts, like we're talking about, short-term volatility is nothing to be concerned for. It's inflation. It's the impact of long-term inflation. The fact that we're not going back to 1970 gas prices is what we need to be concerned about when we're saving, because we need to be outpacing the effects of inflation year over year to actually grow our wealth. And there's ways to do that. There's ways to combat inflation. But one thing is on the short term, you cannot be concerned about volatility when you're talking about a long-term savings account. So that's always something we have to put in perspective, because oftentimes those things get really convoluted and we start to get fearful or emotional about the thought of losing money. But that fear will cause us to do things that will actually ultimately lead us to getting impacted by inflation in a really negative way. And I'll get into more detail about what I mean. So, but for most 403B programs, from our experience and from our research, they're typically too expensive. So actually, what the fees are charging you are not working in your interest because they're typically on a variable fee, and I'll talk about that more. And then oftentimes the rates of return are just too low. They'll give you some type of guaranteed rate of return that typically mirrors inflation. When I say mirrors, usually it's going to give you right about what inflation is. And so that just is, if you think about it, that's just you financially walking on a treadmill. You're just staying in place with how the rest of the economy is doing. You're not actually growing and outpacing inflation to grow your wealth. So we need rates of return to be higher, but that comes at I shouldn't say a trade-off, but it comes at in the form of living with the days, the ups and downs of the market from day to day. So I'll give you this is a pretty straightforward example of differences between trying to fight volatility versus trying to fight inflation. So this is what this slide illustrates. On the right, you see the lower percentage. Obviously, 3% rate of return is the hypothetical rate of return. Well, maybe before I explain the chart, I'll just say this is CTA Cindy. So this is the common educator in California, works 25 years, puts $300 a month away. At the end of her career, she's got $90,000 saved in contributions. So now CTA Cindy has the decision. Do I go with something that fights volatility in the markets? So I can just, it'll give me some promised rate of return, a guarantee rate of return, 3%. Or do I live with a little bit of risk and with the ups and downs in the market, but to allow more growth? And you can see here, obviously, $90,000 of contributions at a 3% rate of return gives you $125,000. Now we have minused out her contributions because if she thinks about it more deeply, $125,000 account, that's a nice size account. But if she thinks about it, I put $90,000 in there of my own money. So what was the real wealth gained from going with that investment? Well, $35,000 would be the net gain. Although it's not the net gain because we still have to factor in inflation for 25 years. We also need to factor in taxes and then the fees that it costs for owning that account over 25 years. Well, you can pretty much wipe out any of the investment returns. That $35,000 after accounting for taxes, inflation, and fees is pretty much wiped out. At best case, she's going to get her money back in that case. But she's not actually going to grow her wealth. Conversely, if she goes with a program that allows for more growth, yes, she's got to feel the volatility of the markets, but she's combating inflation because she's getting higher rates of return, even at an 8% rate of return, which is generally speaking a little lower than the markets are doing. In fact, over the past 10 to 15 years, the markets have averaged well over 10%. So it's not unexpected, or it would be fair to say fairly conservative to have it at 8%. Excuse me for one second. Lots of talking, a little tickle in the throat. Okay. At an 8% rate of return, even when backing out inflation, even backing out taxes, fees, excuse me, still has about $140,000 of true wealth gained. That is just the difference. Same contributions, excuse me, but a dramatically different balance size at the end. So okay. So that was talking about rates of return. That's one side of the coin. The other side of the coin inside of 403Bs is the fees. Excuse me. So what we're looking at here is not rates of return or anything like that. We're looking at a comparison in programs based on the fees and the balance size of the account. So I mentioned before, most insurance companies or a lot of the vendors on the 403B side of things tend to work off of variable fees. This is why this matters. As your account gets bigger, their fees do the same thing. And that's just because it's tied to a percentage of your account balance. So, you know, when you got a small account, it may seem small. I say in this example, it's showing a unnamed variable annuity. Um, I'll leave them unnamed, but it's a very common insurance provider that makes its way across the state. In fact, I think we have a better example towards the end of the slide deck. Uh, it gets into a little more detail, but nonetheless, this is a very common a plan, one of the more average cost plans in California, which is why we use them as an example. Um, the difference between them and CTA is that CTA, we use a flat fee for our program. It's a fixed cost, and I'll get into the details of our pricing structure, but it's just showing you as an example of how not having a variable fee, how much of a difference it means over the course of, as your account balance grows. It's exponential in the effect that it has. And so knowing the price of your retirement account is extremely important because you can optimize your costs. Um, uh, it's pretty obvious. So CTA Cindy again, here we're looking at cost savings based on over her career based on the product she chose, right? So many of those annuity programs, unnamed variable annuities, the average is going to charge 1.75, so just under 2%. In the same example that we showed earlier, with her different balances, not only with if she went with CTA, would she have that higher rate of return on average, but what we're showing here is the fees, the difference in fees. There's a $30,000 difference over the course of her career in fees. So just to be clear, she put in $90,000, and in the average 403B plan, she lost 36 or basically $37,000 in fees. $90,000 in, $37,000 in fees in the average plan. That's substantial, right? So we have to understand how a lot of these insurance companies are making their money and really taking advantage of us in that way. So CTA, we're fixed at $95 a year. It basically breaks down to be $8 a month. And then there's a very small variable cost for the mutual fund company. We don't do any of the investments, so we use mutual fund companies to do the investment and to take advantage of the markets. Good news is because we're a union with over 300,000 members, we have some negotiating and bargaining chips as far as when we can go to mutual fund companies and seek for potentially cheaper mutual fund costs. And that's exactly what CTA has done, by the way. We've been able to partner with the mutual fund companies, BlackRock and Vanguard, to give us negotiated rates for CTA members, which is excellent. Okay, so I kind of had mentioned, we try to filter for companies through our criteria, and that gives us a much lower or smaller list. So, we start with the full vendor list. We're going to eliminate programs that have limited growth potential, right? We want to maximize our rates of return. We want to maximize our growth potential. You have to think about it. So much of your income is potentially going to be replaced to the pension. That's already guaranteed. We don't need more guarantees beyond the pension to be conservative in our portfolios. If we're thinking about this from a practical wealth management standpoint, you're going to have a diversified portfolio. Means you're going to have some parts of your portfolio that's secure, safe, guaranteed income, and then other parts of your portfolio that need to be growth oriented, need to live with a little bit of risk. And if you think about it, your 403b is only just maybe 10, 15, 20% of your income, when your pension is the vast majority of it that's already safe and secure. So our perspective is you need growth in order to outpace inflation. So you need to eliminate programs that have limited growth for that reason. You need to be combating inflation. We also want to eliminate programs with surrender fees and that have commissions associated with enrollment. If some program has a surrender fee, that means you cannot move your money to another plan or transfer it out without getting some type of haircut. And there are programs out there that don't have surrender fees and that don't offer commissions to the people that get you enrolled. And all of that makes your plan cheaper and more flexible. So the last thing that we try to do is we want to eliminate just high fund expenses and fees in general, right? So the actual investments themselves, we want to make sure that the mutual fund costs or the plan expense is actually low, and that they're optimizing costs in that way. So once we do that, we get to a much shorter list. And generally speaking, you can kind of see here we have Pension 2, CalSTRS Pension 2 is highlighted. So they also offer a 403b beyond the pension. It's aptly named Pension 2. Good program. From our perspective, it's actually a better use case if you're on a really limited budget. We would tell you if you can only save $20 a month, I wouldn't tell you to use the CTA program in that case, because our $8 a month fee starts to sound really expensive on a $20 a month contribution. But the way the CalSTRS program is designed, with a small balance and a small contribution amount, it actually would be cheaper than our program to use CalSTRS. The investments are set up very similar, so you're not going to get a whole lot of variation there between CTA and Pension 2. But once you build up a balance of about somewhere beyond $10,000 in a CalSTRS Pension 2 account, their fee structure, although it's lower than most other plans, it still works off of a variable plan cost, which just means eventually there is a break-even point, even with CTA. So in the long term, once you get to maybe saving $100 or $200 a month, and you have about a $10,000 account balance, beyond that is where CTA's fees start to really optimize. So outside of Pension 2 and CTA, Vanguard also offers a really great plan. I know that all three of these are offered in your district. I confirmed that beforehand. So those are the three that we typically would say are designed most similarly, and they meet our standards. Now the Vanguard, we actually use, I think I mentioned, we use Vanguard's funds inside of our own plan. That's just because they're a low cost plan. And so Vanguard themselves, I think if you use their 403b versus CTA, you'd save yourself something like $15 a year. I think they're about $80 a year for the total cost, but it's just more of a DIY plan. So if you're a do-it-yourselfer in the world of finance, I would say it's an excellent place to go and use them all day long. If you like having access to advisors like myself and our team, or having a little bit more support, in the world of in knowing the world of educators, that's what CTA. We have both the do-it-yourself version or the do-it-for-me option within our plan. But nonetheless, if you're in one of these three programs, we're going to say you're in good hands. So, okay, here is we're kind of wrapping up here, so I'll just kind of flow through these last few slides. But this is a cost calculator we designed. So if you have a program already, you can use this tool to compare your fees to the CTA plan. If you're in the shopping phase and you're kind of poking around and want to see the difference, let's say between CalSTRS, Pension 2, and CTA, use the calculator to run an example. It's going to ask for your email. Just know if you're part of the union, we already have your email. We're not fishing for your email. We just want to send you a copy of the projection it's going to run for you. So, okay, here's basically what the comparison tool will look like when it's broken down. So this is a American Fidelity comparison. This is the unnamed variable annuity from before, but nonetheless, this is just a real world example with an account balance of $25,000. You can see how it really starts to snowball for their costs. So I mentioned CTA. We have a flat fee. It's $95 a year. What you're seeing on this chart, why it's increasing, is because of our mutual fund cost that goes beyond the plan cost. So $95 a year is our fixed cost, and then depending on which investment fund you go into, in this case, it averages out what all of our options are and gives you the kind of the standard, which is very low. So for BlackRock, it's like 0.09%. So, for a $10,000 balance, you're looking at like $9 for the year in a BlackRock plan. That's why it's like $113 a year. Yeah, I could go into more detail if you have questions, but you can see that there's a significant difference in the plan fees, just because of our flat cost. It's usually around a 70% savings. So here is I think another equitable, another common 403b plan we see out there. Still very dramatic. You can see as you start to get a high balance, it really escalates. So worth knowing. CTA, just kind of a little bit more of what you may have already heard or know about. But CTA, we have our own plan. It's designed to be low cost and designed to outpace inflation. The whole reason CTA has its own plan is because we did a nationwide search about 15 years ago for 403b products that CTA felt comfortable endorsing, and they couldn't find any. And so, long story short, they changed California state law to allow the union to design its own plan and offer it to its members as a member benefit. So that's what we did. But it's not just a California problem. It's an issue all across the United States. Lots of just poor actors out there, I think, preying upon our educators. So more of what you know: low cost, good investments, no commissions, no surrender fees, fiduciary advice when you want it. Who we use as a management, BlackRock and Vanguard, mentioned that before. We have a fiduciary hotline. I'll give you a link towards the end, so that if you ever wanted to set up an appointment, you can always reach out. Best part is we're not here to sell you anything. We're here to ask you questions and let you ask us questions and help you out. And we're a resource for you. So we always say use us and lean on us, and we'll give you the best advice we have. So just some more details on the CTA plan. There's a new saver incentive. So if you've never had a 403b before, or you're a new educator within the last few years, CTA actually gives you a 1-year credit. Basically gives you waives the first year of our fees to allow you to expedite your savings. And so I think that's a handy thing to know for all you new educators out there, and hopefully gives you some encouragement to sign up. And then this is how you get going. So for us, it's all done online. It's all designed to be self-serving. You can enroll and sign up in like 5 minutes. Second part of our enrollment is we have you connect your payroll to your district. So you make sure you get your salary reduction and agreement in. But just follow the steps through, and we walk you through how to do it all. It's super easy. And then it usually takes the district a pay cycle or two to update. So that's kind of the quick 1, 2, 3. Here's our link for our virtual appointment if you ever wanted a consultation or to chat about one-on-ones. We do that. So I'll leave it with just take action for yourself, for other members. If you heard anything that you thought was worth knowing or sharing, please share this video or share what you had heard because it's important. That's what keeps us a strong union. So with that, I will just kind of flip through the last disclosure slides, and then I think we will shut down the sharing. Hey, I know I've been talking for a long time, so I just wanted to open up the floor briefly if you all wanted to throw any questions at me or run anything by me. I'd be really glad to chat.
I have a question.
Yeah, go for it.
So if we've been teaching for a while and we have one of those other accounts you were talking about, um,
Uh-huh.
if there is no surrender fees, are we able to roll that over into a 403B?
Absolutely. Yeah, and I should have said that or talked a little bit more about that because that's a common question. So yeah, you can definitely move it. But as you mentioned, the surrender fee is the first thing that we're gonna just want to confirm and make sure that you're not going to take any type of loss that you don't need to. Um, and every surrender schedule is going to be a little bit different. But if you do know you do know your surrender schedule, or you are comfortable taking that loss, or whatever the situation is for you, we can show you the process of transferring. And really, it's just a paper chase. We got to get some documents for where the money is being held, and then you'll get some forms from us. But all together, it's not too crazy, and we help members do that all the time. So um,
Okay. And we definitely have to do that before we retire, right?
you would yes, you're gonna. The only way to open up a CTA account is you'll have to be employed through the district
Okay.
to open up a new account. Yeah,
Okay. Okay. Thank you.
you're welcome. Awesome. Let me just flip through some of the um, questions we have here. So we'll be talking about how to sign up for a CTA program. Yes. Do mutual fund companies charge CTA variable fees? Great question, Maria. Yes. It's just a significantly lower variable fee. Um, so like, you know, for what it's worth knowing, the common program, right, is going to charge you 1.75 versus our mutual fund cost is 0.09. So like substantially cheaper. You know, 1.75 in a $100,000 account, that's $1,700 for the year versus 0.09 is $90 for investment costs in a $100,000 account. So hopefully that helps kind of put into perspective uh, what the variable fees are for the mutual funds we use. Uh, and then yeah, and then if you want, I will also put my email here in the chat so that you can reach out if you need to um, ask any more questions or if you wanted to keep it private. But for everyone still on, thank you for joining. Appreciate you all for being here and had a good time. So for what it's worth, take care and enjoy the rest of your evening. Let me get this uh, email in there for you at PUDNT
Thank you. Great information.
Oh, I'm glad you found it useful.
Thank
Thank you,
you.
Phil. All right, take it easy.
You too.